$40 billion. That's not a valuation, it's a declaration. Because when a private tech company tied to the world's fastest growing settlement layer suddenly cements itself as a $40 billion machine, the old financial guard doesn't see a crypto project anymore. They see a threat. They see competition. They see the new rails being welded beneath their feet. And that's exactly what's happening with Ripple. Quietly, deliberately, and now unmistakably. In the last 72 hours, global banking circles have been whispering the same thing. If Ripple's latest $500 million institutional round is real and the valuation is truly locked at $40 billion, then someone, or a group of someones, is preparing for a liquidity shift they can no longer ignore. Because at this scale, Ripple isn't preparing to participate in the next financial system. It's preparing to operate it. What pushed this narrative into overdrive wasn't the money. It was the timing. Right as the Bank of England, the ECB, and the MS in Singapore move closer to tokenized settlement frameworks, Ripple expanded its institutional custody arm again, adding sovereign-grade storage, bond-class token management, and real-time auditing tools normally reserved for the world's largest custodians. That move turned heads because it signals something the public hasn't fully grasped. Ripple isn't positioning XRP as a speculative asset. It's positioning it as operational collateral for a new liquidity map. And that's the phrase that's been circulating behind closed doors. Operational collateral. A new BIS briefing this week described the need for a universal high-velocity collateral layer to support instant settlement between tokenized banks, markets, and currencies. It didn't name XRP directly, but the language matched XRP's design to an uncomfortable degree. Low latency, neutral, globally routable, built for interbank flows. Institutions saw the subtext immediately. Meanwhile, activity on the chain tells its own story. Whale clusters, the smart old money addresses, have quietly increased XRP holdings across the 0.55 to 0.58 bands, marking one of the largest non-retail concentration walls since early 2021. This isn't short-term speculation. These are positions taken by entities preparing for structural demand. Demand that doesn't come from traders, but from corridors switching on. Because that's the part the public still doesn't see. The settlement corridors are already being tested. In the past 72 hours, a European liquidity provider accidentally revealed a cross-asset routing simulation, a flow test that moved synthetic EUR, GBP, and USD tokens between two sandboxed nodes. The infrastructure tagged in the logs, Ripple-based. And although the report tried to mask the source under generic language, the architecture was unmistakable. This is how future settlement tunnels are built. Quietly, in test environments, before a single press release ever hits the surface. And as these tests accelerate, Ripple itself is moving like a company preparing for a consolidation phase. Insiders have been discussing what analysts are now calling the 4B window, a period where Ripple could acquire distressed fintech and compliance companies as regulators tighten control. Think about what that means. Ripple isn't just scaling, it's collecting pieces of the global machine, compliance engines, tokenization labs, digital identity modules. This isn't a crypto firm anymore. This is a settlement empire under construction, but the real story isn't the expansion. It's the reclassification. In the last few days, multiple institutional reports have started placing XRP in a new category. Not currency, not commodity, not speculative asset, but digital collateral. Something you use inside the system, not outside it. Something that powers liquidity routing, backs real-time obligations, and moves through tokenized environments with the consistency of cash, but the speed of light. That shift changes everything. Because speculative assets rise and fall with hype. Operational collateral grows with usage, silently, relentlessly, and permanently. And while the public debates, charts, and cycles, governments and banks are engineering a new structural demand curve. Tokenized bonds need settlement liquidity. Tokenized deposits need cross-bank rails. CBDCs need corridors. Market makers need a neutral bridge. And every one of those systems needs something fast, verifiable, and liquid enough to glue the entire network together. That's why the $40 billion valuation matters. Not because the number is big, because the number is impossible, unless major institutions already know what's coming. The old financial system is choking. 3-day settlements, intermediaries stacked like dominoes, legacy rails patched with decades of compliance tape. No institution with global volume can survive that model in a fully tokenized world. Something new has to replace it. Something built for speed, built for compliance, and built for volume. And Ripple has positioned itself in the exact middle of that requirement. Regulatory familiarity on one side, blockchain efficiency on the other, and XRP, the fast, neutral, liquid middle layer, stitching the two worlds together. This week, Ripple's custody division quietly inked another sovereign client. No name, no details. But sovereign doesn't mean a corporation. Sovereign means a government. That means one more nation state is exploring Ripple infrastructure as part of their digital asset strategy. And when nations start plugging in, everything changes. Because infrastructure adoption isn't speculative. It's permanent. When banks integrate rails, they don't rip them out. When governments adopt a system, they don't switch back. When settlement corridors go live, they don't close. The new system is being wired right now. Beneath headlines, behind boardroom doors, inside pilot programs the public won't see until they're already complete. And when those corridors activate at full scale, the asset that powers them doesn't moon because of hype. It reprices because the function it serves becomes unavoidable. That's the real $40 billion shift. Not the valuation, not the funding round, not the headlines. The shift is the quiet understanding among institutions that the next financial cycle won't be powered by speculation. It'll be powered by rails. And the rails pointing forward, the ones with liquidity, compliance, and global routing, keep circling back to the same asset. Not because it's trendy, because it works. That's why the smartest players aren't talking. That's why the whales are accumulating without noise. That's why the reports avoid naming names, but mirror XRP's blueprint perfectly. And that's why the people who understand infrastructure, not trading, see what's coming before everyone else. Because when the new system switches on in full, XRP won't be the headline. It'll be the engine. And the engine doesn't ask for attention. It just runs the entire machine. That's the $40 billion truth. That XRP's greatest success will be the moment no one even needs to say its name anymore.